Hi, I'm Frank Rotman, founding partner of QED Investors. And I'm panicked about just about everything in the market today.
What's your name?
My name?
Hey.
I'm Knut.
Hey, Nut. I love when people call you Nut.
Speaking of that,
No, you don't get to do the segues. This is my show. Knut,
yes, sir.
what's happening?
Not much.
Do you get offended?
All the time.
I didn't even ask the question. I wasn't going to say by me. I was going to say, do you get offended when smart people, like our guests, will call you Nut? Goodbye, Nut. And I feel bad for you. Do you get upset?
No, actually, I start laughing because I think it's funny.
All right, Nut. So K-Nut. And what about K-Nut? Is that worse than Nut?
No, that's perfect.
All right. Still can't get a nickname out of you. It's a hard nickname. You're stoic.
It's
you're
so short
you're
already.
Icelandic, You're a giant of a man. Speaking of giant of a man. So, segue. Speaking of giant of a man, I was not going to go to the guest. It was to segue to myself. I'm going to pat myself on the back. No, speaking of a giant of a man, we have someone that listen, I'm a fanboy, just like everybody has a fanboy of somebody. Unfortunately, I'm a fanboy of just men, older men, probably not cool guys, but I think they're cool. You know, whether it was Johnny Carson or Dave Letterman or Jon Stewart or Dave Chappelle, George Carlin, and right up there is Frank Rotman, who I have on the show. I don't know if he's funny. I know he's serious, and we're going to find out if he's funny. I know he puts up with my shtick, so he must have a good sense of humor. But Frank is the real deal. Frank is a Midas investor, which is, like, I don't know how to say it. It's like the Academy Awards. He is like a top, by Midas, top 100 investor in the world. He's the founding partner of QED Investors. And I don't know if QED, if you use that on a Scrabble board, means anything, so we'll ask him that. Because I would like, that could come in handy one day if that's actually a word. But QED are fintech operators turned fintech investors. So Frank was early, I don't know if he's early, but 13 to 15 years at Capital One. Have you heard of Capital One?
Yes.
Yeah. And they've turned out some of the great investors, including Frank. DraftKings founder, he came out of the Capital One factory. Frank probably knows a ton of people. He's in Virginia. I think he went to school in Virginia. But it's not important because what's important is what's going to happen in the future. And Frank and firm, I think, just raised $1 billion. But at the same time, Frank, much like me, we're older and we worry about the markets too, and how far, how fast, how frothy, how bubblicious, how boomy it has become. So I want to talk about all that and talk about fintech, obviously because of Capital One background and his ability to spot leaders. I'm in one or two companies with them. I don't think our firms, Social Leverage and QED, have done a deal, but I could be wrong. But anyways, we chat, we see each other online, and I'm excited to have him as a guest. So you want to dial him in?
Absolutely.
Frank.
Hello. How are you?
Hello. I am good. Hello, Virginia. I would love to dig into QED, the firm. Just tell us a little bit about the firm, how many people, this latest round, and what you focus on.
Yeah, so QED, I'm so used to calling us a boutique venture capital fund, and I think we have to drop the boutique now that we're investing out of $1 billion fund. It doesn't feel like it's anywhere close to accurate anymore. But QED is a 14-year-old venture fund that was founded by Nigel Morris, myself, and one other person, Caribou Honig, who has since left the firm. But the three of us had a shared work history in that we helped create what became Capital One. We were really the early guard behind, what you see today. Nigel was the co-founder of Capital One. I was his right-hand man and spent a lot of time building a bunch of businesses that are there today. Nigel was busy scaling everything and dealing with all of the crap of managing a public company. So we had a good shared work history and a good run, taking it from Signet and turning it into Capital One. And we both left around the same time. Nigel left in 2004. I left in 2005. And we joined back up together a few years later to form QED Investors because we thought that our operating backgrounds would be helpful at giving advice to young companies and trying to turn them into big, durable companies, something sustainable. And this thing called Fintech wasn't real back then. There wasn't even a word for it. So we got a little bit lucky because we were going to do this thing and give advice, whether it was big or little, because it was, if I'm honest, the only thing that we actually knew how to do. So we took our advice, we took our capital, and we started investing in companies. It started off as our own capital base and eventually grew bigger than our capital base could handle. Started off just as the three of us, and now we have 17 investment professionals. We're investing in the US, the UK, Latin America, and Southeast Asia. We're very deliberate about that, starting to look at some other areas like Africa. But really, the easiest way to think about QED is that we're operators masquerading as investors. So all we really care about is trying to spot businesses and then help them, become big, durable businesses, figure out how to crack the code on whatever it is that they're building, and help them stand the test of time.
Thanks. I forgot about Nigel. And by the way, handed me Nigel on a call, you and I, it gave me one of the best. I didn't know if he was making fun of me or because he has that accent. It was like very Benny Hill. He called me sardonic. And I've only been in one other meeting where I didn't know. I thought it was a power move, Knut. So I was in a meeting with Dan Loeb one time, and Dan Loeb, just frank, Dan Loeb, like 2 minutes into the meeting goes, you remind me of somebody. I mean, it was a total power move. I was in there with Matt Ober, who I have to get on the show, and to prove that this is a true story. And I'm pitching Dan our fund. And do you know Dan Loeb?
I know of him. I don't know him well.
Yeah, so I'm meeting him first time, and he's sitting in a big room on Park Avenue, and he looks at me, he goes, you remind me of somebody. I'm 1 minute into my pitch. I'm sweating already. And he goes, Ron Popeil. And Matt Ober, who, I don't know if do you know who Ron Popeil was? He's passed away since?
Sure do.
Okay. If someone called you Ron Popeil 1 minute into a meeting, would you take that as a compliment or an insult?
Things just have to roll off at this point. People can call me anything they want.
Okay. Well, it was like I left. I don't know why I was in the meeting at this point. I don't know why he took the meeting, but I immediately took it in the worst way. Ron Popeil was the guy who did like the Ginsu knives and the juicers on TV, Knut, like the salesman schlock of salesmen. It made a fortune, I think. But anyways, Nigel said that I was sardonic. And so I had to look it up. It's a fucking good compliment. So it was one of the great compliments given to me.
Yeah, he has the British accent and uses big words and makes you feel special. So, you're just part of the crew now.
Yeah, I mean, fuck Dan Loeb. And so anyways, so I didn't know Nigel was such a legend. And I think part of my... it's hard to be at the same call. I've only been doing fintech investing maybe 14, 15 years, but you guys were there at the ground floor. How did Signet, how did that deal happen with Signet and Capital One?
Yeah, so Rich and Nigel, who are the co-founders of Capital One, came from a consulting firm called Strategic Planning Associates, SPA, which is really a precursor to Mercer, or today's version of it would be Oliver Wyman. So specialists really consulting to financial service companies. And they had this idea, this information-based strategy that they thought was brilliant and could be applied to the credit card industry, and went around trying to sell it to banks. So they're consultants, they have this idea, they go to all of the big banks, and one by one, they basically get kicked out of the room. The big banks are saying they either do this, or they didn't understand it, or they said this isn't going to work, or they liked their business the way it was. And lo and behold, they, happened to do a consulting project for Signet Bank, which was the 50th largest bank in the country. It really was a geographically focused bank in Virginia, Maryland, and DC. But it had the 10th largest credit card business in the country. And there are a whole bunch of reasons why it had an outsized credit card business, but it had a business. It was big. It had a strategic question about whether it should grow it or sell it or what it should do with it. And Rich and Nigel said, there's this thing called an information-based strategy. We think that the time has come for building a business around information and around data and around experimentation and figuring out, how to have the right product go to the right customer at the right time through the right channel instead of having generic products distributed through, 50 by 50 boxes on street corners called branches. And, they were amazed because after being kicked out of every other room, Signet Bank said, yeah, we'd love to do this, but not with you as a consultancy, but we'd like you to actually leave SBA and come and build this for us. So, Rich and Nigel ended up leaving SBA. They joined Signet Bank. They hired people like myself. I was there in the Signet days. And, after years of working at this thing, which required a lot of infrastructure that today people take for granted, things like data warehouses didn't even exist. So it took years to set up the infrastructure to even store the data so that we could use it. But after years of experimentation and figuring this out, it ends up that it works, right? So risk-based pricing and getting different products into the hands of different people, through the mailbox and through other channels, it actually did work. So the credit card business started to grow faster than the bank as a corpus. And there was a big decision to make about what you do because this business was sucking all of the capital and all of the talent out of Signet Bank. So the obvious answer was to spin it off. And that was kind of the precursor of Capital One. We IPO'd.
Fucking phenomenal. So you were there for the IPO. So my next question is, let's flash forward. It's 2021. The world that I know, or that I fundamentally, even though I went to ASU, there were no fundamentals taught at ASU. There was just sand and drinking. Anything I know about fundamentals is out the window. And we could talk at a high level if it's just interest rates or a different era or a bubble. But today or yesterday, and you have these great tweet storms that I appreciate. The tweet read, nothing is normal anymore. The VC landscape, venture capital landscape, is nuts. Public markets on fire. The adoption of Web 3.0 technologies is unlike anything seen before. Separating bubbles from megatrends is really difficult. It's the stuff of dreams and nightmares. A few thoughts. So it is the stuff of dreams and nightmares. And really what we're in the business of, because we invest for the long term as you do, because we can't touch our companies, is we can't really think about bubbles on the private side. We have to think about megatrends. So, but yet the public markets and the private markets are as part of my thesis, and it's coming true, are moving closer together. So where are we? And let's take apart what you talked about in that tweet storm and let's unpack that and how you feel about the markets. Because on one side you raised $1 billion, so you believed in the megatrend, but on the other side we know we're in some form of hallucinogenic generational boom bubble, and we know the other side of this will be messy, but you can't time it. So unpack that for us.
Yeah, so I have vertigo. This is the stuff that bothers me because at the end of the day, businesses are about manufacturing something that people want and then selling it for more than it costs you to manufacture. Like business is actually really simple if you tear it apart, break it down, and put it back together. The problem is all the fundamentals of building the businesses aren't what's being valued in the market today. And with all of the hype and all of the money floating around, it just messies the picture even more. So everywhere you look, there's another $1 billion company, being made, you're a $1 billion company, you're a $1 billion company, you're a $10 billion company. Like you can't open up Twitter, you can't open up, any type of news outlet without another unicorn being minted. And, there are a lot of good trends and fundamental reasons why these companies are being minted faster than ever before. But if you actually tear it apart and you look under the cover, that's where it starts to get a little bit disturbing because you say, what's actually been built, right? The fundamentals of business are about, basically manufacturing something at one cost and selling it at another. And a lot of these companies that have $1 billion valuations, they really haven't cracked the code on their businesses. They don't really have the scale that historically would come with these valuations. It's hard to value the cash flows. It's hard to understand, how they're going to compete, 5 years and 10 years from now. but they have this nice thing called a $1 billion valuation, $10 billion valuation in either the public or the private markets. And everyone's high-fiving each other when not a lot has necessarily been done. So the dizzying part is like the art of building a business in stages has just been thrown out the window, and it feels like it's not valued the way it was in the past. I think about venture capital as one of the simplest asset classes out there. It's about asking and answering the question, how much can I learn for how much money, how quickly? Right? I mean, it's not that difficult. It's about taking a business that has all sorts of risk, all sorts of unknowns, and figuring out how to flip cards over and say, are you right or wrong? And every time that you flip a card and you're right, you put money behind it, you continue to grow the business. Every time you flip over a card and you're wrong, you've got to go figure out how to adjust the business. You have anti-proof. It's basically telling you you're on the wrong track. You go fix it. And if you fix it, you build a business. And if you don't fix it, you don't build a business. So this art of just flipping over cards systemically and raising capital when you flip over a card and it's a good card, and then putting money behind it, and then raising your valuation, hiring more people, like this systemic building a business is just thrown out the window.
And so there's the one school that says the fact that you can raise $1 billion is a time to walk away. I've been bringing up lately the Andy Kessler story when he was on the runway and he had struggled to raise money, and all of a sudden he raised $400 million on a runway in early 2000. Not only didn't take the money, he just sold everything that he had. Now, he wasn't a VC. He was a public market technology investor. I feel like we're at the same spot now. But at the same time, like you said in your tweet, Web 3.0 is just getting started. So how do you, with a straight face, I mean, people were giving you the $1 billion. I mean, you're great at what you do, and we'll go through some of the companies like SoFi and Current, and we could walk through a ton of the winners that earned you the right to this $1 billion. But how do you reconcile that with where the market is? Do you just sit on it and say we're going to be more disciplined than ever? Or do you how do you play the game when the music is this loud?
Yeah, well, two things can be true at the same time, right? I mean, there can be great opportunities in the market. There could be reasons why giant seminal businesses of the next generation are being built as we speak. It can be true that there are investment opportunities that still have the same return profile that they had in the past. But at the same time, there could be madness, right? There could be bad pattern recognition, and there could be a lot of good money being thrown after bad. There could be a lot of companies that are being built in a sloppy fashion. There could be a lot of money wielded because of the incentive system to just put it to work. That's fueling kind of the ecosystem. But you really have to unpack it all and figure out, where you can play, where your competitive edge is, where you're in the game of positive selection. Because ultimately, if you just threw darts at startups at the earliest stages, you wouldn't build a very good portfolio. I mean, the average startup actually isn't very good, and that's no disrespect to startup founders. It's just a fact with tens of thousands of startups out there, a lot of them just aren't going to succeed. So if you just randomly threw darts, you're not going to win. So, how do you actually build this positive selection loop? How do you find the businesses that are going to be the 10, 20, $100 billion companies of tomorrow? Because there are a lot of reasons to believe that there's going to be a generation of gigantic companies that are going to be built that displace many of the incumbents that are out there. There's so much market share that's at risk right now from the incumbents. And it's unclear whether they're going to be able to adjust and compete, or if this next generation of startup that's being built on very different infrastructure with very different teams, very different distribution channels, very different brands, like this next generation actually could overtake a lot of the incumbents and steal lots of market share. So again, two things can be true, and it's about figuring out where you can find that competitive edge and find the right investments.
I love that take because that's what gets me up in the morning. How old are you now? Give or take 5 years. I don't want to
51 plus or minus. When I wake up in the morning, I feel like 100.
So 51, do you find, and again, it could be everybody's different. My curiosity, I'm 56. My curiosity is at all-time highs, but my ability to do the work is waning. I mean, I got to think that's somewhat normal. Some of it is just I'm softer. I have different interests. How do you feel about that? And how's your workload changed? Because like you said, two things can be true. Like your tweet sums it up, and people, I'll link people to your Twitter handle. I'm like you. There's endless opportunity. The incumbents, and this is why the FANGs are only trading at maybe not as crazy a valuation compared to startups, because there is risk based on Web 3.0 and the way this talent is attacking them now. So there is a lot of risk even at the top. But how do you deal with the fact that you may not be able to work as hard to keep up with your curiosity now that the money's so big? Is it in hiring more people at the team? So that's the first question. The second question is, I find it hard to, push off the investing decision. How do you come to terms with letting other people make these allocation decisions for you? So two questions there.
Yeah, I mean, really, really hard. I actually wish that there were more time to do the work, and I don't mean time in the day, but the VC investing ecosystem has changed so much. I don't know if you felt it, but everyone that we talked to has felt it. We talked to our LPs that are asset allocators. It's crazy. I mean, when I think about how I do my job, when I'm at my best, it's because I understand the business. I can talk to the founder, spend some time getting to know them, really dig into the business and not just take a first call, which, orients you to the business and you get to ask some basic questions. But you have a chance to let your mind actually wander and think about the business and start to lose sleep over it and do some research behind the scenes, talk to some customers and clients, maybe even watch it unfold for a while. But I mean, diligence today feels like a snapshot, and a highly sanitized snapshot of data in some cases that's designed to fool you, where they look at they show you the absolute best view into the company. Everything is sanitized. All the charts look like 45 degree straight up charts. And they say you have a week, and we're expecting term sheets in 3 days. So a week might be too long. So let's have our first call and then tell me if you want to invest. And that's not too much of an overstatement. I mean, I know a lot of VCs that are now being armed with term sheets so that if they like a founder and they like, a first call with them, they're getting prepared to call an IC meeting or just write a term sheet. But it goes against the way that, historically I've personally built conviction. And I think the QED team has historically built conviction, which is really more of a video than a snapshot. Right? Watching things unfold, seeing how it plays out, having time to actually do the work. And during the diligence process, you end up having these really important conversations with the founder and the founding team, and some of the executives on the team, the people who are driving the business forward. And by talking about the business and really digging in, they realize who we are and we get to know who they are. You learn about the business. And, I think what makes us a little different than most VC firms, instead of giving generic advice about, what to do in generic situation X, or just telling them grow revenue and shrink costs, we're there to actually help them think through what to do tomorrow, right? Like specifically, if we were in your shoes, here's what we would do tomorrow. And we're there at their side. And when we write a check, we work for the company doesn't work for us. So we have to be armed as if we're interviewing for a job, to understand the business at that level. And I think the reason why I think today's environment is dizzying is you don't have a chance to do that. And I think what a lot of venture investors are finding and founders are finding as well, I don't know if you've heard this term, but it's a term of art that I love, which is the first board meeting after you make an investment is the oh shit board meeting.
Of course.
Because at that point, you actually know what you invested in. People start telling you the truth at that point. You start to see data that you're wondering where it was during diligence. You've had a chance to actually learn more about the company. And a lot of VCs that I'm talking to are having those oh shit board meetings and saying, oh shit, like this is what I actually invested in.
Fantastic. Second question then is exactly what you're saying. Now extrapolated down the food chain. You're hiring people that are green, maybe not green, but because you guys can afford to go deep and hire experienced people. But now you're pushing these decisions, and these younger people may only know from this. So how does QED arm these 17 other people that you work with to go do same in this environment?
I mean, this is what we're talking about every day. I mean, the environment has changed so fast that we're reinventing how we do our jobs. I mean, the average partner at QED has something like 15 years worth of work experience. So it's not an inexperienced team. And the work experience that they have is spot on for the type of investments that we're doing. So we're all ex-operators. We've all built things and managed things. There are some people who are a bit more junior and coming up, but, even the most junior people have amazing experiences, amazing pedigrees, and they're wickedly smart. I would put our team up against, any of the venture teams out there. Just such a talented group that we've assembled. But it's still hard. We try to true back to fundamentals. We try to true back to what it's going to take to build a real business. And the problem is a lot of the investing that's being done today is more about talent scouting. It's about saying, look, this is a great team. Here's a problem that they've identified. Who the hell knows how they're going to solve it? But let's go plant some capital with them. Right? I got lots of money. We've got all these LPs that gave us the money. We get paid our 2 and 20. 2 sounds really good. 20 is an option if we end up getting this right. Like, let's just go put a whole bunch of money to work by planting it in the hands of founders that we think are tackling big problems, and then let them figure it out. And I know that's an overstatement to make a point, because there are some unbelievable venture investors out there who I respect wildly. But, a lot of the venture investing game, especially as you go early and earlier, has turned into a team and TAM game. And it's not even a team and TAM game anymore, because a lot of venture investors have given up on TAM because they say, who the hell knows how big this could be if it works? So let's just go talent scouting, right? And find great teams and say, look, I want 20% of your business, or I want 10% of your business. How much money do you need? And to me, then valuation turns into a division exercise, right? It's just basic math. How much money do you need? Here's how much ownership I need. Like, go build a business. And that's your valuation. And again, all of these things are just very, very different from how I personally think about businesses.
Fantastic. Now, how low will QED go? What is the check size range? Because you have other funds. So can you write a 500K seed check, or are you done with that and only A and B?
No, I mean, we have different programs for writing smaller checks. You can imagine a smaller check out of $1 billion fund. It needs to move fast. It needs to be a conviction-based bet by the individual investment professional on the team. It can't run through the entire machine. Like, if we were running 500K checks through our machine, then we're just going to blow ourselves up and it won't work. So we have a fund specifically for Latin America called Fontes that writes some small checks. We have a program that is about to come out of the ground in the US called Bolt, that will write 250K to, $1 million or $2 million checks, but move incredibly fast, into some of these rounds that are closing quickly. But realistically, what we're looking to do is to get in as early as possible. We want to get in before it's too crowded. The reason for bringing QED on the cap table is because we help crack the code on the business. We're ex-operators, we're hands-on. We're not about being talent scouts and then just letting the founders go off and do their thing. So we're not for everyone. But in order to make that model work, you have to put more money to work. So a lot of these smaller checks are about getting a toehold into the company and getting them to learn us and getting us to learn them, so that we're comfortable actually writing the bigger check and they're comfortable taking it from us.
And so a new phenomenon, and I'll ask selfishly since I have you on and inside baseball, is because valuations have gone up so much. We went from a period in 99 where VCs were killed, the companies went public, they never sold, and stocks plummeted. And it was a disaster in terms of, earnouts and the carry, to a period where you look stupid if, as a VC fund, you sell your stock when the company goes public, a la Square or Shopify or, even SoFi. So how do you, as a VC, deal with it when a company goes public now? What do the LPs want, and is it case by case, or do you just say, we'll distribute the stock and you guys decide? Is there any kind of lesson you could offer there for young VCs listening in?
Yeah, I mean, it's an incredibly good question. You have to understand the origin of QED to answer the question from our perspective, because when we started for the first 7 or 8 years of QED, the money was our own. And by that, is mostly Nigel's, but my money was at work as well. And, we were out there investing our own capital. So when we started to see, some of our companies actually explode, so we were one of the earliest investors in Credit Karma, as an example.
Mm-hmm.
And, when you see how much embedded gain you have in the company, you start to think about it in a very different way and say, I still believe in the company. I believe it's an amazing company, but maybe it's time to take a little bit of capital off the table. And for us, it was important because we're recycling our own money into new investments. And it's not a bad thing to dollar cost average in public markets, both up and down. It's not a bad thing to dollar cost average in the VC world. It's just the incentive system isn't aligned that way because it's not an IRR game. It's a cash on cash game.
Correct.
And in a cash on cash game, like once you put a dollar out there, like you don't care what the IRR is. I mean, maybe your LPs do. You actually should care about it quite a bit. You should be a good steward of capital, but you'd rather have that dollar that's out there keep working. Because ultimately when you have your liquidity event, that's what carry is going to be calculated off of. So there's a weird incentive in, the VC ecosystem to just hold out as long as you can. Let the good companies continue to accrete value. Hold on to them in the public markets if your LPs will allow you to hold on to them. But then you get into a weird world of panic selling, or how do you sell if you're on the board of a public company? How do you responsibly, think about the company being an amazing company and, helping them navigate growth while you're selling down your position over time? Like it's actually pretty challenging. So I don't think there are right or wrong answers, except to just internalize that the incentive system is a bit backwards, right? It incents you to actually hold on to things as long as you can, even when the right answer, if it were your own account, would be to delever over time, as you see the IRR decreasing and as you see better opportunities to put money to work somewhere else.
This is great. So I appreciate you answering this because we have these issues and I'm sure you've had them and a lot of the people listening will have them one day. But 99 had so much, there was so much memory there, muscle memory for the VCs that of course, if something would rarely go public, for the next 15 years in tech, well, not rarely, but, IPOs peaked and then, for 10, 15 years were lower. You would just distribute the stock or sell at the IPO. But now we have this weird trend back towards these days that you talk about in your Tweetstorm. Like, how do you, if I'm a VC investor, am I a public market investor? So you're saying you don't know the answer.
But the question is like, what makes you a good public market investor, right? I mean, being a good private market investor, is about giving really solid long-term advice to companies. It's about setting up the company for success. Early on, it's about cracking the code on the business. And later, it's about, building up your moats and figuring out how to compete in a hyper-competitive world where you're already at scale.
Mm-hmm.
Once you're a public company, it's a different game. I mean, you're now managing analysts, you're managing long-term forecasts, you have governance. I helped manage a public company and I was part of it. And it's just a very, very different game, than managing a private company. So a lot of the venture investors who might be extraordinarily talented at saying, how do we string together kind of a learning agenda and enough good answers over a 7-year period or 10-year period that we've built a decent business or a great business? But it could be that that's a very different set of skills and advice that you would need to give to a public company where everything is disclosed. It's about managing a lot of other constituencies in a very different way.
Let me ask the question a different way because I apologize then. You're an LP in a seed fund and a company goes public. As the LP, would you want your manager to distribute the stock and mark the time there or leave it up to the manager to say we're going to hold it as a public company?
If I were the LP, I would want the stock because either the early stage investor is a better manager of all of the public information that's out there, or they're not. And if they're not, then why are you paying them for the stock to accrete, or why are you paying them to make the buy-sell decision on the stock? So, ultimately you've got to ask, like, are they a good steward of that capital? Yes, no. If they're a good steward of the capital and the company is still taking advice from them and they still are growing the company in the public markets and they're actively involved, like that's one situation. It's very, very different. And in fact, selling when you have, that level of accountability and information flow is very different as well. You're locked out. You have to have a selling strategy. You have to register. Like it's actually pretty difficult to be selling down stock if you're still actively involved with the company. But if you're not actively involved with the company, so if you're a seed investor and you get the exact same information that everyone else gets, why should you get paid to manage the money on behalf of your LPs once the company goes public? Like it's a non sequitur to me. It just doesn't make sense.
Thank you. That was what I was looking for. I agree with you. So it'll be interesting as these markets go on. I think I'm trying to think through, Frank, and I'm maybe not doing a good job, but you're answering my questions beautifully, is how the fuck this ends. Do you think about that ever? Or, I mean, our job is not, we're paid, it's not like being a public market investor. I have so many thoughts because I ran a hedge fund forever, maybe not well. Who knows? I survived, beat the market, but I hated it. Hated every minute of it. Hated more every day in hindsight. Hate myself for letting myself do it for so long. But I totally believe that throwing darts in the public market can work. But yet in the private markets, like you said, good luck. I think it could be a disaster. And that's because obviously so many more companies and so little, not as much information. And so in your world, what's our next moment where Sequoia writes a letter saying, what makes Sequoia write the next letter?
So, yeah, I love their letters. We all read them. We all try to internalize them. And then at the end, we go back to doing what we do.
Correct.
But look, the first principles of investing, I think you can never get away from, which is that businesses exist to make money. Not everyone likes that. It's not a popular opinion, but the reality is businesses exist to make money. And there's this correlation that's existed forever, 100 plus years running, 95, 98% correlation. I haven't looked at it recently, that if you want to understand the price per share of stock, look at the earnings per share of the stock. When earnings per share grows, the stock price grows. If companies make more money, they're worth more money. And everything that happens in between is just trying to guess how fast is the company going to grow? How much into the future am I willing to pay for an earning stream? How durable is that earning stream? But at the end of the day, like businesses collapse to a single equation, which is if you make more money, the business is worth more money. And I think that's where everything is falling apart right now. And the question is whether these companies can outrun it. Because you look at things like PE ratios in the market, right? And a lot of people who haven't really been investors through different markets, like they don't look at things like this. And a lot of people will, okay, boomer me for talking about a lot of these metrics. But the reality is like the PE ratio in the market today, I think it's 35 or something like that. It means that, for every dollar of earnings that's coming in, or for every share of stock that I buy in the public market, it's going to take 35 years of earnings to basically pay me back if there were no growth in the market, right? If none of these companies grew, it would take 35 years to pay me back, for basically buying a share of stock. And that's not sustainable unless you believe that the market is growing incredibly fast, that these public companies are growing at extraordinary rates. And, if you actually look at some of the companies that are going public with, negative earnings, they're burning tons of cash. They have years to go before they actually hit escape velocity. You look at the revenue that they're earning, relative to their valuation, and there are big disconnects there as well. And that's where I think the disconnect is. Can these companies outrun it? Are they fundamentally going to steal market share from some of the incumbents? Is there going to be a next generation of company that unseats the last generation? Is this digital world and this digital adoption, just going to, build a new set of companies and a new set of logos that we've never heard of before? If the answer is yes, then there's a lot of rationality to what's going on. It just will take time to play out. But if not, then we've got a problem on our hands. This is a bit of a blow your mind statistic, but I think of being a big, durable, real company as something like being part of one of the Fortune 1000, right? I mean, it's an artificial way of looking at it, but just think about it. If you're one of the 1,000 largest companies in the US, you're a real company at that point. And a lot of the startups aspire to be one of those real companies. If you're number 1,000 on the Fortune 1000, you're bringing in $1.8 billion of revenue a year, right? And we're talking about companies in the private markets that have single digit millions to low double digit millions of revenue that are high-fiving each other because they're now unicorns. And like there's a disconnect here between how much has been accomplished and the narrative about this being a company of the future and look at the great prospects for this company and like where they actually are. And it doesn't mean that I think it's wrong. It just means that I think there's bad pattern recognition and it's not right for every company, right? For some companies, they will earn their way into it. They will grow their way into it. They're growing at, just unbelievable rates that I've never seen before. Companies can grow at 10x year over year. Back when I was doing this 14 years ago when we started QED, like our best companies were growing at 2x year over year.
Right.
Now, like they can grow 2x by the time we, sign a term sheet and get the paperwork done.
Yep.
So there definitely is something happening, but if the bottom of the Fortune 1000 is 1.8 billion of revenue, like it's going to take a lot for these companies to grow into their valuations.
Love that context. Couple more questions and I'll let you go. The next question is you have so much background in banking and credit and lending. Interest rates. I'd be crazy not to ask you, what do you think about negative rates in this 60-40 portfolio that half of the country, who mom and pop, who doesn't have access to crypto, the government doesn't want them to be able to do this in their IRA, right or wrong. They don't want to get into the politics of it and they can't invest because they're not accredited in private markets. How do you think about rates in this world? Or do you just say, fuck it, we're VCs, I don't care about rates?
No, it's hard not to care about rates. It's something that once you see, you can't unsee because, the rates actually affect the value of a dollar.
Yep.
Right. I mean, a dollar is not a mark-to-market asset in a lot of ways. So if inflation really, really kicks up, we could find ourselves in a decade similar to the 1970s, let's say, or 1980s, where the end of the decade, things will be 60% more expensive, 70% more expensive than they were at the beginning of the decade, right? And who knows if that's going to come true? Who knows if inflation is really going to persist or it's going to, be reined in under control? But some level of inflation is here. And whether things at the end of the decade are 60% more expensive or they're 30% more expensive, like inflation is a real force. And it means that we're in an environment where saving money is basically watching it erode value over time. And that means that there's an incentive to put that money to work. It means that owning durable assets actually matters quite a bit. It means things like owning real estate is an amazing trade.
Yep.
Not all real estate, but
location. Location means a lot.
Yeah, location means a lot. Is it an earning asset? Is it well managed? Like all of these things matter, but ultimately owning hard assets matters a lot. And for a VC, if you think about the fact that a dollar that you put to work today, if you just left it in the bank, might be worth 70 cents at the end of the decade, why not put it into a high growth company that's growing at rates that are so far beyond the rates of inflation that, it's just a great asset to be investing in at a time when effective interest rates are upside down. So I think a lot of the phenomena is in the market, especially the public markets, can be attributed to inflation. And I would ask anyone who doesn't understand the impact of this to just take your favorite company, any company at all, look at their projected earnings in the next 2, 3, 4 years, whatever information you can get your hands on, and go throw different interest rates on it and discount that flow of projected revenue and the projected earnings of the company based on different interest rates. And you'll see how impactful it is having interest rates at different levels. So if people haven't run through that exercise, like you don't understand what's happening. And companies could be worth 50 to 100% more than they would be worth in a more normal interest rate environment just because of where the interest rate curves are.
And what is normal? Like, what would get you scared?
Scared.
3% on the 10-year?
Well, I mean, inflation affects different people in different ways.
Yeah.
And that's why this one generic statistic is so hard. And even calculating it is nearly impossible.
Mm-hmm.
So let's start by saying it's impossible to calculate.
Okay.
You know, there are flaws of every single methodology. The question is, are things are they becoming more expensive than they were in the past? And, you know, the answer is yes. The question is how much more expensive, and are there other forces that can make up for it? You know, so things like minimum wage, are we going to see big increases in minimum wage? You know, we're starting to see a lot of pressure on that. Whether the government gets behind it or not, you're seeing employers start to push up minimum wages in order to bring in the talent that they need to have the labor they need to run their businesses. So there are a lot of forces and counter forces, you know, that are at work here. But what I'll say is we've really entered a period where, you know, saving is not a really smart thing to do in traditional, you know, bank accounts, and figuring out ways to convert the savings into investments in high growth companies in the stock market, in tangible assets like real estate. You know, and some people will claim that crypto is the answer for all of this because, you know, you can basically invest in ways that you're preventing or fighting the forces of inflation, or maybe even outpacing inflation in some cases. So, you know, it's just such a strange environment where, you know, the old days of just planting money in a bank account and earning more than inflation and letting it compound over time, like that just doesn't exist.
I love that take. I'll leave it with that. I've hit the age, 56, you're 51, where I've hit the age where I'm taking money out of ETH and putting it into, I'm taking my money out of crypto, which sounds dumb, and buying. I never thought I'd be the guy buying real estate. But, you know, to me, on the beach real estate, whether it's high tax California or zero tax Florida, makes so much more sense to me than crypto at my age. But yet I love crypto. And part of why I just keep taking gains off the table in crypto is because obviously I can't enjoy myself in the digital world, and I can go enjoy it. So I think at some point this money comes back. You know, I think Fred Wilson had this point a few years ago. It's like whatever's over in digital is staying in digital. How do you feel about that at your age and as a firm with $1 billion? Where are you on this Web 3.0 and DeFi as someone from the credit side? How deep have you gone?
We're exploring. We are not one of the firms that's deep, you know, into DeFi and crypto. We have a couple investments in the space, and some of them are more picks and shovels type investments that we can understand as reformed bankers. So Bitso, as an example, is our biggest position in crypto, and it's a great company that is doing great things in Latin America. But it's really Rails, you know, for moving crypto around. And that's something that once you figure out that crypto isn't going away and that people want it, you know, investing in the Rails that efficiently can move it around or store it or do things with it, you know, that's an investment that we understood. But this world of Web3 is just, you know, to use the word again, it's dizzying because it's a different set of philosophies. It's a different set of first principles. You know, if you go all the way to the maximalist side, it's a different set of values about how everything from organizations are formed to where is their trust, and, you know, do you need any central oversight at all, or can code, you know, substitute for people and regulation? So, you know, code and incentive systems replacing, you know, people being accountable for regulation, like it's just a different world. So we're spending our time thinking about it and diving in, but ultimately we're very pragmatic investors and look for the areas that we feel like we can be helpful to the businesses. So I would say we're still going on the journey. We're still learning, and one day maybe we'll be helpful. And if we're helpful, then we'll start investing in the space. But right now, we believe that all of our companies need to be crypto aware. They need to understand that people want this stuff. It's not going away. And if you're not enabling your customers to do what they want, then you're going to be a last generation company. So, we're definitely on board. It's just a matter of, are we skilled enough to find the right companies to be helpful from an investment standpoint?
Now, you've been doing this a long time, so and our firm is still just in growth phase. You know, we've been fortunate to ride this wave. How do you deal with something when you've been really wrong? Walk people through, as a professional VC, how have you and Nigel dealt with something when you've just been extremely wrong?
Yeah, I mean, look, a passion of mine, if I go back 15 plus years ago, was that I played a lot of mid and high stakes poker. And there are a lot of things that you can learn from being in that space because you can't be results focused, right? You can't be outcome focused. You have to think about the repeatability, because repeatability over time is how you generate like a real durable edge. So if you know why you made the decisions that you're making, then you can examine the outcomes and say, wow, was I wrong when I made the decision that I made? Was there a fact that I didn't see at the time, or something that was flawed in my logic? Or did the world play out in a very different way, something that we couldn't have foreseen when we made the investment, but with the facts that we had at the time, it was a good investment? So we try to hold ourselves true to the decision-making process with the facts that we knew at the time, but there's a lot of this about just asking yourself, what is the logic behind your investment? And, because we're very thesis-based investors and, we underwrite with purpose, we could go back, or at least I can speak for myself personally, I go back to just about any company that I've seen that I spent significant amount of time with. Give me 5 minutes, just look over my notes. Any of the companies over the past 14 years, I could tell you precisely why we passed or why we made an investment decision. And, because, I'm not losing that knowledge, I can true back when we see outcomes and can say, look, where were there mistakes made? Where did I not understand, something about the ecosystem or something about the founder or something about how the startup was built? And then you just try to get better over time. But you can't beat yourself up over, companies that you ended up missing or companies you invested in that went wrong. What you can do is beat yourself up over faulty logic. If you had a sloppy decision-making process and you just threw money around and it ended up not working out, you're the fool then. You've got to hold yourself accountable to making decisions in a way that you can repeat them and stand behind them.
Well, you're a pro. I've got an hour more of questions, so we're just going to have a part 2 and talk about fintech in general. I just felt like I rarely get a chance to talk to someone with this much experience in the markets where they're at and the VC markets where they're at and the success that you guys have had and continue to have. So I appreciate you taking more of a educational look at this for the audience. I want to talk more next time if I can get you about the type of stuff that excites you. The stage that excites you most personally, is it A or B, or is, where, if someone wants to reach out and work with Frank?
Yeah, I mean, we're investing as early as formation stage. So we build businesses from the ground up. We just like to get involved before the code has been cracked. We do have a growth fund, so we can invest a little bit later if we missed a company on the way up, where we still think we can be helpful. But really our sweet spot is when a company is still young and trying to figure things out.
So there you have it. Easy to find on Twitter. You also love writing, and I think that's an important part for every young investor, whether you're public or private, is it's not who reads it, it's that you have a process in sharing it and getting feedback, whether it's one person or 1,000 people. It's really a thrill to get to talk to you for this amount of time, Frank. I hope the rest of the year is fantastic. Congrats on this new fund, and I look forward to working on some deals here between Social Leverage and QED.
That sounds like a plan. Well, we have to figure it out.
Thanks, Frank. Have a great weekend.
Same to you.
Cheers. Canute.
Yes.
That's a legend. You can spot a legend.
He's so eloquent.
Yeah, so 170 plus podcasts, you can spot them, right? We got the fast talkers. Doesn't mean they're sneaky or tricky. Everybody has a different pace, but the way he thoughtfully took those questions and answered them, it's pretty impressive.
Very.
So that is Panic with Friends. We talk to venture capitalists, Midas investors, traders, philosophers, entrepreneurs, and we try and think about the future. Frank had some great insights about how two things can be true at the same time, how we can be in a bubble but still see massive opportunity. If you like what you hear, my name, Howard Lindzen. Go to Spotify, Apple, my YouTube channel, search my name, subscribe once a week. We have these podcasts. Thanks, Canute, for putting this together. Thanks, StockTwits, for distributing it, and we'll see everybody next week.
Howard Lindzen is the founder and general partner at Social Leverage. All opinions expressed by Howard and podcast guests are solely their own opinions and do not reflect the opinion of Social Leverage or StockTwits. This podcast is for informational purposes only and should not be relied upon for decisions. Guests may maintain positions in securities discussed in this podcast.
And one day maybe we'll be helpful. And if we're helpful, then we'll start investing in the space. But right now, we believe that all of our companies need to be crypto aware. They need to understand that people want this stuff. It's not going away. And if you're not enabling your customers to do what they want, then you're going to be a last generation company. So we're definitely on board. It's just a matter of, are we skilled enough to find the right companies to be helpful from an investment standpoint?
Now, you've been doing this a long time, so and our firm is still just in growth phase. You know, we've been fortunate to ride this wave. How do you deal with something when you've been really wrong? Walk people through, as a professional VC, how have you and Nigel dealt with something when you've just been extremely wrong?
Yeah, I mean, look, a passion of mine, if I go back 15 plus years ago, was that I played a lot of mid and high stakes poker. And there are a lot of things that you can learn from being in that space because you can't be results focused, right? You can't be outcome focused. You have to think about the repeatability, because repeatability over time is how you generate like a real durable edge. So if you know why you made the decisions that you're making, then you can examine the outcomes and say, wow, was I wrong when I made the decision that I made? Was there a fact that I didn't see at the time, or something that was flawed in my logic? Or did the world play out in a very different way, something that we couldn't have foreseen when we made the investment, but with the facts that we had at the time, it was a good investment. So we try to hold ourselves true to the decision-making process with the facts that we knew at the time, but there's a lot of this about just asking yourself, what is the logic behind your investment? And, because we're very thesis-based investors and, we underwrite with purpose, we could go back, or at least I can speak for myself personally, go back to just about any company that I've seen that I spent significant amount of time with. Give me 5 minutes to just look over my notes. Any of the companies over the past 14 years, I could tell you precisely why we passed or why we made an investment decision. And, because, I'm not losing that knowledge, I can true back when we see outcomes and can say, look, where were there mistakes made? Where did I not understand, something about the ecosystem or something about the founder or something about how the startup was built? And then you just try to get better over time. But you can't beat yourself up over, companies that you ended up missing or companies you invested in that went wrong. What you can do is beat yourself up over faulty logic. If you had a sloppy decision-making process and you just threw money around and it ended up not working out, you're the fool then. You've got to hold yourself accountable to making decisions in a way that you can repeat them and stand behind them.
Well, you're a pro. I've got an hour more of questions, so we're just going to have a part 2 and talk about fintech in general. I just felt like I rarely get a chance to talk to someone with this much experience in the markets where they're at and the VC markets where they're at and the success that you guys have had and continue to have. So I appreciate you taking more of a educational look at this for the audience. I want to talk more next time if I can get you about the type of stuff that excites you. The stage that excites you most personally, is it A or B, or is, where, if someone wants to reach out and work with Frank?
Yeah, I mean, we're investing as early as formation stage. So we build businesses from the ground up. We just like to get involved before the code has been cracked. We do have a growth fund so we can invest a little bit later if we missed a company on the way up, where we still think we can be helpful. But really our sweet spot is when a company is still young and trying to figure things out.
So there you have it. Easy to find on Twitter. You also love writing, and I think that's an important part for every young investor, whether you're public or private, is it's not who reads it, it's that you have a process in sharing it and getting feedback, whether it's one person or 1,000 people. It's really a thrill to get to talk to you for this amount of time, Frank. I hope the rest of the year is fantastic. Congrats on this new fund, and I look forward to working on some deals here between Social Leverage and QED.
That sounds like a plan. Well, we have to figure it out.
Thanks, Frank. Have a great weekend.
Same to you.
Cheers. Canute,
Yes,
that's a legend. You can spot a legend.
he's so eloquent.
Yeah, so 170 plus podcasts, you can spot them, right? We got the fast talkers. Doesn't mean they're sneaky or tricky. Everybody has a different pace, but the way he thoughtfully took those questions and answered them, it's pretty impressive.
Very.
So that is Panic with Friends. We talk to venture capitalists, Midas investors, traders, philosophers, entrepreneurs, and we try and think about the future. Frank had some great insights about how two things can be true at the same time, how we can be in a bubble but still see massive opportunity. If you like what you hear, my name, Howard Lindzen. Go to Spotify, Apple, my YouTube channel, search my name, subscribe once a week. We have these podcasts. Thanks, Canute, for putting this together. Thanks, Stocktwits, for distributing it, and we'll see everybody next week.
Howard Lindzen is the founder and general partner at Social Leverage. All opinions expressed by Howard and podcast guests are solely their own opinions and do not reflect the opinion of Social Leverage or Stocktwits. This podcast is for informational purposes only and should not be relied upon for decisions. Guests may maintain positions in securities discussed in this podcast.
Name, subscribe once a week. We have these podcasts. Thanks, Canute, for putting this together. Thanks, Stocktwits, for distributing it, and we'll see everybody next week.
Howard Lindzen is the founder and general partner at Social Leverage. All opinions expressed by Howard and podcast guests are solely their own opinions and do not reflect the opinion of Social Leverage or Stocktwits. This podcast is for informational purposes only and should not be relied upon for decisions. Guests may maintain positions in securities discussed in this podcast.